is the DeFi Decoded podcast by 9 Point Partners. The ideas and opinions expressed in this podcast should not be taken as investment advice. Always consult with your financial advisor before investing.
Hello and welcome to another episode of DeFi Decoded. I am Alex Tapscott here with Andrew Young. Andrew, I don't know if this room looks familiar to you. This is a room where you and I recorded the FTX episode exactly a year ago. Well, maybe not exactly a year ago, but we had just come back from a conference and we'd found out that FTX was going under and that no one was there to save it. A very different market environment today. Obviously, crypto is rebounding. Bitcoin's held above $40,000 for the better part of a week. And now we're starting to see some market breadth across the board, including some nice upticks in the ecosystems that we look at, such as the Cosmos ecosystem. We've had a lot of conversations over the last couple of weeks about market dynamics and price and catalysts and so forth. And today we're going to have a different kind of chat because we're very fortunate to have a guest, Leo Mindyuk, the CEO of ML Tech. ML Tech's a company that I've gotten to know pretty well over the last little while. The firm has basically built a platform that connects institutional investors with portfolio strategists and investment managers who are investing across a range of different strategies, starting first in the crypto asset world, but eventually diversifying into other asset classes. It's a very interesting platform for crypto in particular, because there are a lot of smart people who haven't necessarily built and operationalized a fund before, and ML Tech is basically a platform that makes that entire process extremely easy to do. And so far, they've had a lot of success. They've grown from zero to almost $80 million of assets on the platform in the better part of a year and a half, 2 years. And going to next year, have quite a bright future. So really interested to hear what Leo's got to say about these different strategies that are operationalizing on the platform, also the nature of the investors who are interested in ML Tech and kind of where he sees the growth coming from here, both for his business and also for the investment space as a whole in the asset class. So Leo, welcome to the show.
Thank you for having me.
Yes. I'm right here. Okay, sorry, I just had to do that.
Yeah, thank you for having me. The market is definitely very different than it was a year ago after FTX. We've seen a lot of interest from institutional clients coming into the space, reaching out to us, learning about systematic strategies that we've been running. We have a marketplace of strategies that fit the different needs for the customer. So for example, we have delta neutral and market neutral strategies that are a little lower risk and allow investor to get absolute returns monetizing on the volatility of the asset class. And then we also have some directional strategies that take exposure and monetize the movements also in the Bitcoins as well as some of altcoins.
So I think like a lot of people who have built businesses in this space, you started off as a trader yourself. And I'd like to understand a little bit about the journey that you took from trading in general, but also the asset class, and how you came to decide that you thought a platform was better business.
Definitely. So as many people in the space, I also started in traditional finance. Initially was doing algorithmic strategies in equity options, stocks like Microsoft, Apple, tech stocks primarily. Then I moved to high frequency trading of CME and Eurex futures across different asset classes. So run high frequency trading strategies. And some of the strategies, so they can be applied to crypto markets, and crypto markets at the time, this was back in 2017, so 6-7 years ago. So back then, there was a lot of opportunities across cross-exchange ARB, as well as just inefficiencies within the same exchange or different related pairs on the same asset. So I ported some of the strategies from traditional markets to crypto markets. Then by 2019, the company that I was with, we built algorithmic OTC desk where institutional clients can execute through our liquidity via OTC platform, UI platform that we built, as well as through API and RFQ system. And for that, I saw that a lot of those institutions that were executing through our liquidity, they wanted to get exposure to also systematic strategies that we were running kind of on prop side. And for them, they had two options how to get exposure to those uncorrelated systematic strategies. They can basically build in-house operations, which takes a lot of time, expertise, and resources, or they can invest in hedge funds in the crypto space. The problem with hedge funds in the crypto space is that there was a lot of uncertainty around like where your assets are, what the hedge fund is doing with your assets, what kind of strategies they apply. Do they really apply the strategy that they discussed they will apply? And there are a lot of kind of horror and bad stories around the hedge funds kind of running away with the investors' money, and a lot of fraud in the space back in the day. So I kind of saw this inside that those institutional investors, they want to have transparent, secure, and more controlled way of getting access to systematic strategies in the space. So this was insight primarily from my work. And then from my personal network, a lot of classmates from MIT who I studied with, as well as like people who I met in the industry, they left their traditional jobs, right? So they were in hedge funds, like large hedge funds in traditional markets, and they would leave to start their own small prop firms or hedge funds, seeing that there is opportunity in the asset class, seeing similar opportunities that I saw when I started CryptoDesk back in the day. So for them, it was challenging to start because you have so many different exchanges, you have all the operational complexity, you have kind of complexity of actually talking to the investors. And many of these people, they're very smart and they want to focus on the signal creation. They want to focus on finding these inefficiencies in the market. They don't want to deal with technology infrastructure, operational complexity, getting money for the strategies. So that's how idea for MLTech started. So basically we connect the smart strategy creators with institutional capital on the other side. The strategy creators, they use our API to send signals to our infrastructure. It goes through our risk management, portfolio management system, as well as execution. So we optimize execution for the fastest and minimize impact when the order is actually executed. And then institutional investors, they can connect and select particular strategies. It all runs on the account of the investor, so we don't take any custody. And with this approach, the investor is able to select their own custodian, prime brokers, and we do the automated algorithmic systematic management of their assets.
So Leo, you mentioned a couple of things there that I want to drill down on a little bit more. One of them was that with the hedge fund, there's all these risks, and some of them are risks of the fund themselves, and sometimes it's the counterparties or the vendors or the custodians that they're using. What venues are they trading on? What custodian are they using? And as an LP, you send money to them and they're kind of become the custodian of the assets. They're in charge. With your platform, it sounds like investors have a lot more control. And as a result of that, a lot less risk. Can you just walk us through like kind of step by step how that works?
Definitely, yeah. So with our platform, investor has a control to choose where they want to store the assets, what exchange they want these assets to be traded on. If they use prime broker, what prime broker they're using, what custodian they use. We see right now a lot of interest from institutional clients for off-exchange custody solution, where exchange is separated from actually the custody, where the assets sit on off-exchange completely in a cold wallet, and then the exchange gives a credit line to trade and generate volumes and opportunities from the exchange liquidity. So with our approach, investor has the control of choosing the service providers, and they know exactly which strategy is applied on which exchange, so they have full control and visibility for what's happening. And after FTX and kind of Free Arrow last year, we've seen that there's a lot of interest in having this control and doing your own due diligence as the investor on which service providers chosen. So we can focus on the strategy and provide the best investment management solutions possible in the control of the investor's accounts.
Interesting. Andrew, do you want to jump in? I've got a ton more questions here.
Yeah, no, totally. I mean, I think it makes a lot of sense. I guess it actually really reminds me from sort of the TradFi world. I'm not sure if you remember this company called Quantopian. It was kind of like a marketplace for quants to build their own strategies. And it almost sounds like the crypto version of Quantopian, but more for more obviously like targeting institutional investors. I remember I think they partnered with sort of Steve Cohen back in the day. And then there's another firm as well called World Quant. Again, I'm sure you're sort of familiar with them. They have like a whole university where almost like again, like sort of decentralized quantitative trading movement, where there's just so many sort of so many statistical arbitrage strategies that can generate alpha that it's almost, the universe is so big. And I think particularly within crypto, there's just it's even, to me at least, it seems even more inefficient than the sort of traditional world. So I guess my question really is, I guess, how do you sort of think of ML tech relative to kind of like, I guess, the first generation of this, like what I would call the decentralized quant movement in terms of like Quantopian and World Quant? And I guess like, how have you kind of looked at their successes and failures to sort of inform how you guys are running your company?
Yeah, definitely. So very familiar with Quantopian and World Quant. Actually, we have someone from a management team who was previously at Quantopian on the management team. I know the founder of Quantopian as well, so kind of been talking with him quite a lot early on in our stages. So big difference for us is that we focus on more professional traders who already have like, it's typically teams. So it's not like independent, like amateur trader that just trying something new. We actually work with people who already have experience, who already have some sort of understanding of the markets. Typically, they would come from traditional finance and they would move to crypto. And it's a higher level of barriers to actually post your strategy. With us, we have significant due diligence that basically allows us to select the best strategies that are out there. With crypto market, there's actually a lot of benefit of having this distributed network of traders, because some of the traders, they find very specific ideas that it's difficult to find when you're in centralized experience. So bigger World Quant to some extent is a better similarity, because they also typically work with more professional traders. I actually like to think of us more as a Millennium or Citadel type model, where you have a lot of different pods, and then the big difference with us is that those traders, they can be anywhere in the world. They can use our infrastructure. They get the same access to infrastructure as they will if they will go to and work for a proprietary trading firm or large hedge funds. So they can use this latency optimized and really high quality infrastructure and connectivity to exchanges, while keeping the independence and keeping their intellectual property to themselves, instead of giving it up when they go and work for traditional hedge fund. And we've seen that with the recent kind of trends in the market, there is a lot of overall a gig economy. So people want to stay independent. They want to monetize their ideas, and they just need a better infrastructure and access to capital to do this in systematic way. So that's where we come in.
Yeah, I'm so interested to know how this could be applied to basically anybody who wants to automate all of the back end and the trading and all of those different functions. I can see why tons of strategists would want to be on the platform in order to gain exposure to distribution, right, to gather assets. But I can also imagine tons of people who might just want the service itself, right? The software as a service model of just sort of like automating all of that back end, and maybe they would gladly trade away a little bit of the fees that they would otherwise earn for doing that, right? So, like, are you thinking about expanding it beyond just the investment management side to more of like a technology offering itself?
Yeah, that's a great question. So as we were building the infrastructure to power this marketplace of strategies and powering everything related with portfolio management, execution, risk management, performance reports, and like billing, a lot of like back office and mid office operations, we basically found ourselves in the position where there's a lot of infrastructure that we built that market participants in crypto space need, right? And we think for next year it's going to be a good opportunity for us to offer this infrastructure and technology that we built as a service. We built it in a very modular way. So, for example, if the investor wants part of portfolio management system, they'll be able to have this. We also think in how we can monetize connectivity to exchanges in this low latency framework that we've built. So yes, that's on our roadmap to expand not just be an investment manager solution, but also be a software provider to power this growing ecosystem.
And I'm more curious also on like can you sort of dive into sort of the types of strategies that I guess are maybe more popular or just kind of maybe have performed better, and I guess and also if you can kind of distinguish sort of if there's any sort of unique differences between these strategies in the crypto world versus kind of like the sort of TradFi world.
Definitely. So recently, we've seen a lot of demand for strategies where the client can put Bitcoin or Ethereum or other altcoin as deposit assets. So they maintain the exposure to this asset longer term. So for example, they may have a long-term view on particular token and they want to maintain the upside that they see from the market appreciation, but at the same time, they want to generate additional yield on that. And that's where we've seen that strategies that are able to accept different deposit assets and help investor generate yield on top, they've been extremely popular in this market. We also seen that now, especially in the recent kind of market up move, we've seen there is more interest in more risky directional strategies, and that's what we've been building recently and focusing on diversifying from more absolute returns, delta neutral and market neutral strategies that are a little less risk and kind of like higher Sharpe to more directional strategies that monetize inefficiencies and the momentum in the market.
That makes sense. And then I guess the key question there, obviously, with generating yield on your crypto assets is counterparty risk. I'm a lot of the sort of Bitcoin lending strategies from I've talked to a ton of sort of different crypto quant firms. A lot of them seem to use sort of Bitfinex. That seems to be kind of like the nexus for a lot of this stuff. So I guess I'm just kind of curious how how do you sort of deal with the counterparty risk of particularly with the Bitcoin lending strategies. Obviously, that's a big risk we saw in the last cycle with Celsius and all those types of things. I think most of the sort of weak firms have obviously been mostly weeded out, and I think most of the sort of centralized exchanges where you can do this type of Bitcoin lending strategy are quite strong at this point. But I'm just kind of curious, I guess, how you guys go about managing that risk. I know ML Tech itself is non-custodial, but I guess how do investors think about that, and if you guys help them manage it as well?
Definitely. So it's typically up to investor to decide which exchanges they're comfortable with and what custodian they want to hold their assets with. We've seen that recently there are tech solutions as well as qualified custodian solutions where you can keep your assets outside of the exchange, so you don't have you mitigate the exchange default risk. We've seen this really popular with institutional investors in the current market. And right now, there is actually a lot of large banks that are working on the solutions around this. So we will see movement more to traditional asset type of model where you have the separations across custodian, prime broker, exchange, and the investment manager who is us in this scenario. So overall, we rely on the investor to some extent to decide their own service provider and decide where they're comfortable with. Most of our strategies are portable across exchanges, and we can work with different type of custodian and prime brokers that investor wants to use.
I'm so curious to dig down a little bit on the investors themselves, not who they are specifically, but rather like what is the makeup of the typical investor? Because you've got on the one hand, someone who's savvy enough to know what venues and custodians they should be using. I mean, in a way, that's not something that every wealthy individual or family office would even know. But also who maybe knew enough to this that or not already invested, this might be their first sort of like foray into investing into these different kinds of strategies. So like where are you finding the model has the most traction right now?
Yeah, so we've seen that primarily with the investors who already know something about crypto. Typically, they would be whether like VC investor or they'll have certain positions just by buying and holding like Bitcoin or Ethereum. So we've seen that fund of funds, family offices that are more crypto native or crypto friendly, those ones are a good target for us. We also seen traditional asset managers that want to get exposure to crypto. They basically think of us as a, like outsourced investment manager, and they may have their own preference on custodian or prime broker, but they rely on our expertise in actually investment management in digital assets to help them. We also started to target more crypto native players like liquid venture capital and crypto who have long-term holdings of certain coins and they want to generate additional yields on that, as well as the token treasury. We see that the token treasury, there is a big potential because right now they basically don't do much with their treasury and they can generate yield whether in the same coin or in stable coins. So we've seen a lot of demand from this type of crypto native players as well.
Yeah, that's fascinating.
And then,
go ahead, Andrew.
Yeah, I wanted to ask. I mean, if I guess I'm kind of curious, like if with the integration with sort of the DeFi ecosystem, or at the very least the sort of like C DeFi ecosystem, which is kind of like where you can get exposure to DeFi through centralized exchanges. I'm kind of curious how you sort of think about that space and whether there's sort of I guess demand and maybe also sort of supply of strategies for playing around in the DeFi space, or I guess like what challenges or obstacles need to be sort of overcome for that to become like more of a playground for these types of funds.
Yeah, so we typically don't touch much of DeFi. The reason why, well, right now we concentrated on CeFi as well as like traditional exchanges like CME. And the reason why is because there's a little bit, there's basically missing framework for how to work with DeFi, how it's treated. So there's a lack of regulatory clarity around how to treat DeFi. So this actually prevents like really large institutional capital coming in. And a lot of strategies that we've seen in DeFi, because we are exposed to this ecosystem of strategy creators, we see that a lot of those strategies are very low capacity. So they wouldn't be able to scale even if the institutional capital will come into the space. I think it's going to be changing over time, especially as we get more regulatory clarity around DeFi and just overall DeFi ecosystem will be growing. But for now, it's difficult to deploy significant amount of capital into DeFi strategies. And it's also because of lack of regulatory clarity, not many institutional investors actually comfortable with getting this exposure. And outside of this, there's also a question of who actually have the custody, right? And who is have the permissions to transfer money out, right? So for example, when you interact with the protocol, if the investor has a keys and then you have the key and then the trader also needs to be able to interact. So there's some issues with the permission controls that makes it more difficult to have an kind of external investment manager like ourselves managing your assets on the DeFi protocol. There are certain solutions now that kind of solving this or trying to solve this, but it's still not very institutional ready at the moment. So right now we focus more on CeFi.
So where does all the growth come from in the next year? Like right now, you've had some initial success with some funds and funds of funds that are crypto knowledgeable. How do you sort of blow the doors open on the business?
Yeah, definitely. So for us, there are two kind of categories. One category is like crypto native, like token foundations. We are seeing now that a lot of those token foundations, they realize that they need to do something with their tokens. As you can imagine, those token foundations, they have a lot of assets and they don't have a good solution where they can control those assets and still generate returns. They don't want to kind of be in the position like with Celsius, right? Or some other ways how they were generating yield in the past. So for them, it's actually a very interesting solution. And I expect a lot of growth from this segment next year. And then outside of this, institutional asset managers, we've been in due diligence process with some of them for a long time, and now it seems as the market start picking up and as we will get into ETF approval, as well as like additional clarity, especially in the US around digital asset framework, we will see those traditional asset managers coming into the space and wanting to work with a crypto native type of investment platform like ourselves.
Very interesting. Andrew?
Yeah, I guess, I mean, that kind of sort of, I am more curious to learn a little bit about kind of, I guess, like the difference more between sort of I guess, like from your take, like the alpha available in the crypto markets for these types of quantitative strategies relative to sort of the TradFi world. Because, you know, like the quantitative trading within TradFi world is obviously extremely competitive. And we've seen a number of sort of crypto quant funds that have emerged over the last couple of years that, you know, they were doing maybe okay, or they were sort of from the sort of traditional world, but then when they started applying their strategies to the crypto world, it was incredibly profitable. And so I am kind of curious, you know, like, especially like a strategy like Momentum, it seems like Momentum would be incredibly profitable as a strategy within crypto, whereas, you know, it's a bit more of a competitive strategy, competitive sort of quantitative strategy in the equity markets. So yeah, I guess I'm just kind of curious about like what sort of, I guess, the difference in profitability for strategies that could be applied to both TradFi world and crypto, and if there's sort of a material difference.
So in crypto space, there are still a lot of inefficiencies. It's also related to just having different exchanges in different geographies, different type of products available on those exchanges. So there is a lot of nuances about actually understanding underlying products on the exchange. So having this like crypto expertise. And then we see that a lot of strategies that's been working well in traditional markets, they work even better in the crypto markets because of increased volatility, as well as this basically decentralization in a way of those exchanges, of this. There is no unification across the products, across type of margining, for example, that exchange gives. So this allows a lot of opportunity for very unique alphas that don't exist in traditional markets. So example, maybe on certain exchange, you may have coin margin as well as like USDT margin type of products. And there's no such thing that, in traditional markets that you can explore, right? So it gives much more variety of type of strategies that you can basically take from traditional markets, modify, given this very crypto specific type of products that you have, and then generate higher returns because of inefficiencies and higher volatility in the market.
Yeah.
And then big picture, like going in, I was just going to ask, like going into the future, like, do we expect this to continue? Like, is this going to remain a very inefficient market, or do you see, as with other traditional markets, the opportunities getting very, you know, arbitraged away, and there becoming more efficiencies? And I'm wondering, both in terms of your platform and the broader market, how many different strategies can be, how much AUM can quantitative strategies support in crypto? Like, what is the total sort of addressable market for that? And then, well, that would be sort of, let's start with there, and then I'll do a follow-up.
Yeah, so in terms of addressable market, it's going to be growing. So right now, I think it's easily can support multiple billions, but it's never close. It's not as close to like traditional markets where you have trillions of AUM to deploy in those type of strategies, right? So my long-term view is actually all the assets will be tokenized, and we will see total addressable market growing as these assets will become tokenized. In terms of inefficiencies, there is going to be some unification that will reduce some of the inefficiencies that exist, but at the same time, there's more interest and continuous innovation that happen in digital assets. There's going to be new opportunities that will emerge, and we will see this. I've basically been getting similar question back in 2017-19, right? And we will see that, yes, maybe opportunities that were profitable back in 2017 or 18, they don't apply anymore, but you have some new innovative products and some new ideas that still inefficient, and there's always this process of innovation in digital assets, which also creates this growing inefficiencies. So overall, I would say that right now the space is still relatively small, but it's been growing, and with this constant innovation, we will see these inefficiencies continue, and there will be a lot of trading opportunities for years to come.
Yeah, I like that idea of there being basically all assets as tokens, because we're talking about them tokens right now as like a discrete asset class. And today there are probably, a few ways in which tokens are being used, whether it's as cryptocurrencies or as tokens of protocols like Ethereum, or as governance tokens for DAOs or NFTs, et cetera. But ultimately, if you view blockchain as a new medium for value, that is in many ways superior to how things work today. You have perfect information, immutable records, real-time settlement. Then it stands to reason that most, if not all, kinds of assets are going to be tokenized at some point. And I think that probably when that happens, it's not going to be because existing big companies like, say, Apple decide to tokenize their existing stock outstanding. That won't happen right away. But I do think that new enterprises, new kinds of businesses that launch are going to start with a token first model. And I actually think that that's basically what's happening in DeFi and DSocial, DAI, and all these other DePIN. Basically, the idea that you start with the premise that the thing where the value accrual occurs is a token, and that token is something that gives you a say in and some ownership of a decentralized network, all right? And I just think like the big picture, of course, is that not that there will be arbitrage opportunities between exchanges in the same small basket of tokens, but rather that this is the kind of platform that can support investment into the asset class of the future, basically, and that asset class of the future will be in the trillions of dollars, because that's the value of all assets in the world, right? So I think that's worth keeping that long-term perspective in check.
Yeah, definitely, 100%. We share the same vision, and that's where ML Tech comes in to serve these different tokenized assets in the future. So we expect that the market is going to become total addressable markets is basically going to be all the assets out there that will be tokenized.
Well, that seems like a pretty good place to leave it off on the tokenization of everything, and ML Tech as the platform where everyone will invest in the tokens of everything. But Leo, thank you very much for joining us. Leo and I are in the same room right now, but we are apart by a few feet. But it's been nice having an actual live conversation. I don't know if anybody who's watching the video is picking up on this. Obviously, if you're listening on Apple or Spotify, you won't have seen this. But yeah, Leo, thanks for coming in. Thanks for a great conversation. AY, terrific questions as always. Very perceptive. And we'll hope to have you back maybe in a few months or a year when you've executed on this strategy for the first part of 2024, and we can revisit the thesis. So thank you, Leo. Thanks, Andrew. That's it for today's episode of DeFi Decoded. Thank you for everyone for tuning in. We will see you next week. We actually have a couple killer guests, additional killer guests lined up before year end, so you'll want to tune in. That's it for now. Take care.
The information contained herein does not constitute an offer or solicitation by anyone in the United States or in any other jurisdiction in which such an offer or solicitation is not authorized, or to any person to whom it is unlawful to make such an offer or solicitation. Prospective investors who are not residents in Canada should contact their financial advisor to determine whether securities of the funds may be lawfully sold in their jurisdiction.